Understanding the basics of stock investing. Before diving into specific stocks, it's essential to have a clear understanding of stock market fundamentals. What is a stock? A stock is like a small piece of a company. When you buy a stock, you own a tiny part of that company. For example, if a company is like a big pizza, each stock is a small slice of that pizza. By owning a slice, you share in the company's success or losses. If the company does well, the value of your stock can go up, and you might even get a share of its profits, called dividends. It's a simple way to think of owning a part of a business without having to run it yourself. A stock represents a piece of ownership in a company. When you buy a stock, you become a part owner, giving you a claim on a portion of the company's assets and profits. It's a way to invest in a business and potentially grow your money as the company grows. There are two main types of stocks: common stock and preferred stock. Common stock is the most popular type, offering voting rights in company decisions and the possibility of earning dividends, which are a share of the company's profits. Preferred stock, on the other hand, typically doesn't include voting rights but provides fixed dividends, making it a more stable option for those seeking regular income. Both types of stocks allow you to benefit from a company's success, but they offer different advantages depending on your investment goals. The stock market has two main types of participants: retail investors and institutional investors. Retail investors are everyday people who buy and sell stocks for their personal accounts, like someone purchasing shares of their favorite tech company through an app. Institutional investors are large organizations, such as pension funds, mutual funds, or hedge funds, that invest big amounts of money on behalf of others. For example, a mutual fund might pool money from thousands of people and invest it in various stocks to grow everyone's savings. Think of it as individuals versus teams in the market. The New York Stock Exchange, NYSE, and NASDAQ are the two biggest stock exchanges in the US, each with its own style. The NYSE is home to many large, well-established companies, often referred to as blue-chip stocks, like Coca-Cola and General Electric. NASDAQ, on the other hand, is known for featuring technology and growth-focused companies, such as Apple, Microsoft, and Tesla. Think of the NYSE as a classic powerhouse, and NASDAQ a hub for innovation and tech trends. Types of stock research. When researching stocks, there are two main approaches: fundamental analysis and technical analysis. Fundamental analysis looks at the company itself, its profits, debts, and growth potential. For example, if you're considering investing in Starbucks, you might check how well its sales are growing worldwide or how much profit it makes per store. On the other hand, technical analysis focuses on stock price charts and trends, like noticing if Tesla's stock tends to rise every time it hits a certain price. Think of fundamental analysis as studying a company's report card and technical analysis as spotting patterns in its behavior. Fundamental analysis. This means looking at a company's financial health and the bigger economic picture to figure out its true worth or intrinsic value. For example, analyzing Apple's sales, profits, and market trends can help determine if its stock price reflects its real potential. It's like digging into the details to see if what you're paying matches what the company is really worth. Key financial metrics. Key financial metrics help you judge a company's performance. Earnings per share, EPS, shows how much profit a company makes for each share, like dividing a pizza among friends. More slices mean more value per share. Price to earnings ratio, PE, tells you how much investors are willing to pay for $1 of earnings. A high PE is like paying extra for a trendy brand, but it might not always be worth it. Revenue growth shows how much a company's sales are increasing. Think of it as a growing tree, promising a bigger harvest in the future. Lastly, dividend yield is the portion of profits paid to shareholders, like getting a cash reward for being part of the company. For instance, utility companies often offer steady dividends for income-seeking investors. Financial statements. The income statement tells you if a company is making a profit or losing money by showing its revenue, expenses, and profits. It's like a report card for the company's performance over a period, such as a quarter or year. The balance sheet gives a snapshot of what the company owns, assets, what it owes, liabilities, and what's left for shareholders. Equity, kind of like checking a person's bank account to see their savings and debts. The cash flow statement tracks the actual cash coming in and going out, helping you understand if the company has enough cash to keep running smoothly, similar to checking if your wallet is full enough to pay bills. Example, Warren Buffett, one of the world's most successful investors, often speaks about the importance of understanding a company's fundamentals. He famously said, "Price is what you pay, value is what you get." Technical analysis. Technical analysis is the study of stock price movements and patterns to predict future trends. Instead of focusing on a company's fundamentals, it looks at charts and historical data, such as price and volume, to identify patterns. For example, if a stock's price has been consistently rising after dipping to a certain point, technical analysts might predict it will rise again when it hits that price. It's like trying to guess the next move in a game based on previous moves, helping traders make decisions about when to buy or sell. This approach focuses on stock price movements and trading volumes to forecast future price movements. It uses charts and historical data to spot trends. Key indicators in technical analysis help traders predict stock trends. Moving averages smooth out price data over time, making it easier to spot long-term trends, like finding the average average temperature over a month rather than focusing on daily fluctuations. The Relative Strength Index, RSI, shows whether a stock is overbought or oversold, helping investors decide if the price is too high or too low. Bollinger Bands indicate a stock's volatility. When the bands widen, it means more price movement is likely, while narrower bands suggest less action. Chart patterns like head and shoulders signal a potential reversal in price direction, while cup and handle suggests continued growth after a small dip. Jesse Livermore, one of the pioneers of technical analysis, famously said, "The stock market is filled with individuals who know the price of everything, but the value of nothing," reminding us that understanding the true value of a stock is as important as knowing its price. Investment styles and strategies. Investment styles and strategies refer to the different approaches investors use to manage their portfolios and achieve financial goals. One common style is value investing, where investors look for undervalued stocks, those priced lower than their intrinsic value, hoping the market will eventually recognize their true worth. A well-known example is Warren Buffett, who focuses on buying quality companies at a good price for long-term growth. Another style is growth investing, which targets companies that are expected to grow faster than the market, even if their stocks are more expensive. Investors in this category, like Peter Lynch, focus on companies with high potential, such as tech startups. Dividend investing focuses on stocks that regularly pay dividends, providing income for investors while also offering potential price appreciation. Lastly, index investing involves buying a broad market index, like the S&P 500, to diversify risk and match the overall market's performance, making it a more passive and low-cost strategy. Each strategy offers different benefits and risks, depending on an investor's goals and risk tolerance. Value investing. Value investing is a strategy where investors look for stocks that are undervalued compared to their true worth or intrinsic value. These stocks are often priced lower than their fundamental value, and value investors believe the market will eventually recognize this and the stock price will rise. Common metrics used to find these bargains include the PE ratio, price to earnings ratio, book value, and dividend yields. For example, Warren Buffett, one of the most famous value investors, focused on companies like Coca-Cola, American Express, and Geico, which were solid, profitable businesses, but often underpriced by the market. Key metrics for value investing include looking for low PE ratios, high dividend yields, and strong return on equity, as these indicators can suggest that a stock is undervalued and has potential for growth. Benjamin Graham, known as the father of value investing and mentor to Warren Buffett, famously said, "The intelligent investor is a realist who sells to optimists and buys from pessimists." This quote reflects the core of value investing, finding opportunities in stocks that others overlook or undervalue. The realist part emphasizes that a smart investor looks at the facts and financial fundamentals, while the optimists and pessimists refer to the market's emotional swings. In other words, when others are overly optimistic and driving stock prices too high, it's a good time to sell. When fear and pessimism drive prices too low, it's a good time to buy. Dividend investing focuses on stocks that pay regular dividends, providing a steady income stream for investors. This strategy is particularly attractive to those looking for stable earnings and strong cash flow. Dividend investors typically target companies with a history of consistent profitability and reliable payouts. Examples of popular dividend stocks include Johnson & Johnson, Procter & Gamble, and PepsiCo, which are known for their dependable dividend payments. The key metrics for dividend investing are dividend yield, the annual dividend paid as a percentage of the stock price, and dividend growth rate, how much the dividend increases over time, both of which help investors assess the income potential and sustainability of their investments. Warren Buffett's famous insight, "The stock market is designed to transfer money from the active to the patient," reflects his belief in the power of long-term investing. He suggests that the market rewards those who are patient and willing to wait for their investments to grow over time, while those who constantly buy and sell based on short-term movements are more likely to lose out. Buffett's strategy focuses on finding quality companies and holding them for the long run, letting time and compounding work in his favor. This wisdom highlights the value of patience and a steady, long-term approach in the world of investing. Macroeconomic and market factors play a big role in influencing stock prices and overall market conditions. Understanding these factors helps investors make informed decisions. Interest rates are a key factor. When rates are high, borrowing costs rise, which can reduce corporate profits and make stocks less attractive to investors. On the other hand, lower interest rates make borrowing cheaper, encouraging investment in stocks. Inflation also impacts the market. Rising inflation erodes purchasing power, meaning consumers can buy less, which can hurt corporate earnings and lower stock prices. Finally, GDP growth is another important indicator. When the economy is growing, it often signals a healthy stock market because companies tend to perform better in a thriving economy. Keeping an eye on these factors helps investors understand how the broader economic environment can affect their investments. Example, during the 2008 financial crisis, stock markets plummeted due to a mix of poor economic conditions, subprime mortgage issues, and high leverage in financial institutions. Investor behavior and sentiment. Investor behavior and sentiment play a crucial role role in shaping stock prices, often driven by emotions like fear and greed. When fear dominates, investors may sell off stocks, causing prices to drop, and this can lead to stocks being undervalued. On the other hand, when greed takes over, investors might drive prices too high, causing stocks to become overvalued. Market cycles, which include bullish, rising market, and bearish, falling market periods, also influence investor behavior. Understanding these cycles helps investors know the best times to enter or exit sell the market. Recognizing whether the market is in a bullish or bearish phase can guide decisions to maximize returns and minimize risks. Warren Buffett's famous quote, "Be fearful when others are greedy and greedy when others are fearful," captures the essence of investor sentiment and market cycles. He advises that when the market is overly optimistic, greed, stock prices can become inflated, creating a risky time to invest. Conversely, when fear dominates and stock prices fall, it could present a buying opportunity, as undervalued stocks may be available. Essentially, Buffett's wisdom encourages investors to go against the crowd, buy when others are scared, and sell when others are overly confident, leading to more thoughtful, long-term investment decisions. Resources for stock research. Resources for stock research are crucial for making informed investment decisions. Financial news sites like Bloomberg, Reuters, and Yahoo Finance offer the latest updates and analysis on market trends, economic news, and individual companies. For a deeper dive into a company's financial health, SEC filings, like the 10K and 10Q reports, provide detailed insights into earnings, risks, and other key data directly from the company. Stock screeners, such as those offered by Morningstar and FinViz, allow investors to filter stocks based on specific criteria like PE ratios, dividend yields, or growth rates, helping to identify the best investment opportunities. Additionally, brokerage platforms like TD Ameritrade, E-Trade, and Charles Schwab offer research tools, analyst ratings, and detailed company reports, making it easier for investors to track their portfolios and access valuable insights. These resources help investors gather all the information they need to make informed decisions. Building a stock portfolio. Building a stock portfolio requires a thoughtful approach to balance risk and reward. Diversification is key. By investing in different sectors and asset classes like stocks, bonds, and real estate, you reduce the risk of a single investment dragging down your entire portfolio. It's like not putting all your eggs in one basket. Risk tolerance is another important factor. Understand how much risk you're willing to take on. For example, if you're risk averse, you might focus on conservative, income-producing stocks like dividend payers, while if you're willing to take more risk, you could invest in growth stocks that may offer higher returns but with more volatility. Finally, adopting a long-term perspective. Investing consistently over time can lead to better returns than frequently buying and selling. This approach, like Warren Buffett's, allows you to ride out market fluctuations and benefit from the long-term growth of your investments. Warren Buffett's quote, "The stock market is a device for transferring money from the impatient to the patient," emphasizes the importance of long-term investing. It reflects his belief that the stock market rewards those who are patient and willing to hold on to their investments through market fluctuations, rather than those who constantly react to short-term market movements. By focusing on diversification, risk tolerance, and a long-term perspective, along with utilizing resources like financial news sites, SEC filings, and stock screeners, investors can build a balanced and informed strategy. Integrating insights from famous investors like Buffett helps you stay focused on the bigger picture and make decisions that align with your financial goals. Enjoyed this video? Don't forget to like, comment, and subscribe for more tips on stock investing. Hit the bell icon so you never miss an update. Ready to start investing? Check out our resources link below to help you get started today.